Hello, my dear students. Let's add value to your knowledge account today. I'm Dr. Bharathi Sunil. Welcome to our part 2 of Basic Accounting Term Series. The main objective of conducting this series is to get the knowledge of complete accounting terms which are generally used in our financial accounting. If you come to know about these terms, it will be very easy for you to understand the coming chapters, whatever we are going to do in our videos. I can definitely say that you will gain good knowledge about basic accounting terms and you can learn the other chapters very easily. Let's start today's session. Yeah, after learning all the terms, whatever we are going to cover in today's session, you will definitely understand our language of business, that is accounting. The first term, entry. What is entry? Whatever the financial transactions we are doing in our business, all those transactions will be entered in our books of accounts. So what is that called? That is called entry. Next, voucher. What is voucher? Whatever the receipts or payment transactions we do in our business, for all those transactions, we have to show some proof, that is evidence, that will be in the form of bill or that can be in the form of invoice, so that we can have accuracy of financial records in our business. Next, goods. What are goods, commodities, things, or articles, whatever we deal in our business as a trader? What is our intention here? To make resale, right? So, whatever the products, whatever the commodities we are buying for the purpose of reselling are called goods. When it is a trading business. But when we are doing manufacturing, whatever the raw material we are purchasing, to convert that into finished goods, that raw material is called our goods. Whatever the goods that are lying with us on closing date, those goods are called stock. Next, account. What is account? All the financial transactions, whatever we are doing in our business, all those financial data we will put in organized manner. That means we are recording all financial transactions in the form of account. That account can be in the person's name or in the bank's name or in the firm's name. So whatever the accounts we are preparing, we prepare those accounts in T shape. That I will explain you in the coming terms. Expenses. What are expenses? The expenses what we are incurring on regular basis. Those expenses are called like rent paid to landlord or salary paid to our staff, or if you are paying our electricity bills every month or telephone bills, whatever the payments we are making regularly, all those payments are called our expenses, right? Next, losses. What is loss? Whatever the expenditure we are making, but that expenditure is not giving us any benefit. Okay, so here I would like to give an example. We bought some assets and we have used in our business, but when we are selling that assets after some time, we are getting loss. Say, for example, you purchased one car, right? So when you purchase a car in the year 2020. But after using that car for 5 years, when you are selling that asset, you are getting loss. Means after deducting the depreciation also, whatever amount that is remaining, that amount also we are not getting, right? So that means what? That is called loss. Okay. If there is any loss on sale of assets, or because of any reason we have to pay damages to our customers or suppliers who are the parties we are dealing with, or any loss due to natural disasters, like because of floods, whatever the material we stored in the godown that got spoiled, right? So all these losses, whatever our company is facing, these amounts are also called expenditure, but for which we have not received any benefit. Is it clear? So an expense brings some benefit, but loss does not bring any benefit, right? So what are expenses we have discussed here? Rent paid. Okay. What are the losses we have discussed here? Goods that are destroyed due to fire. Next, revenue. What is revenue? Whatever the earnings of your business. Okay, what are the earnings generally we make? When we sell our products, we receive sales proceeds, right? And whenever we are rendering any services, for that also we receive amount. And when we are investing some money in any investments, we receive our interest. And when we are doing any activity for that, if we receive any commission, all these are called what? Revenue. Clear? Next, profit. What is profit? Profit is the positive amount. Means what? Whatever the revenue we are generating, out of that revenue, whatever the expenses we are incurring, what is left with us is called our profit. That means profit is equal to revenue minus all expenses. Next, debit credit. This is very, very important in accounts. If you know debit and credit very clearly, you will understand how to prepare journal entries. When you know preparation of journal entries, ledger will become very easy and all the remaining process will become very easy to you. So try to understand this debit and credit. Nothing is difficult in accounts. Just if you put efforts, that will be definitely resulting you to get good knowledge in accounting. Okay, prepare account in T form, right? So when you prepare accounting T form means when we are drawing this account, all this side is called debit. Means our left hand side is called debit and our right hand side is called credit. It means how you will write DR is called debit. Okay, to debit an account means to enter the transactions on the debit side of the account. Means here we will enter all the transactions on the debit side. When we have to credit, we enter all the transactions on the credit side. For the present sake, if you understand this much, it is sufficient, because when we go into depth, you will understand all the concepts very clearly. Entering transactions on our left hand side, it is called debit. When we are entering on our right hand side, it is called credit. Okay, next. What is journal here? Journal means what are the transactions first we are recording in our books in entry form. Entry form means I will show one entry here, but before understanding what is entry, first you should know that it is the first recording in our books. Okay, so that is why it is called what? Original entry. Here, this will follow double entry bookkeeping. Means for every debit, there is a corresponding credit. Remember that. What is double entry? For every debit, there is a corresponding credit. Here, we can see in this example, when machinery purchased and paid cash. Means when you have purchased one machinery, we have to pay amount to them, no? So how we have paid? We have paid in the form of cash, right? So here what we are writing, machinery account data to cash account. I will explain you how these entries will be prepared in our journal entries concept. Okay, whenever we are writing one entry, our debit amount should be equal to the credit amount. Is it clear? This is called what? This is called entering our transactions in journal entries form. Next, ledger. What is ledger? All the entries, whatever we have written in our journal, all those entries will be transferred to ledger into appropriate accounts. Say, my name is Bharathi, okay, Bharathi account. And say if I'm having my account in SBI account, okay, and my channel name is Finance and Accounting Academy. Okay, if I receive any amount for my channel, what is my account here? Finance and Accounting Academy channel. We are having three accounts. What are those three accounts? Bharathi account, SBI account, Finance and Accounting Academy account. Okay, so three accounts I have mentioned. In the same form, in the same way, whatever the transactions we enter in the form of journal entries, for all those entries, we have to prepare accounts. This slide, I showed you measuring account debtor to cash account. Means what are the two accounts we have showed here? Measuring account, cash account. So when we have to prepare ledger, we'll prepare measuring account and we'll also prepare cash account. Then when we prepare measuring account, in here we'll write it. Here we wrote accounting name, no? In this place we'll write measuring account and we will write whatever the things that will come on the debit side and whatever that will come on the credit side, we'll write on the credit side. So ledger is the most important book of the business. Hence, it is called king of books of accounts. Next, trial balance. Okay, from ledger, whatever the balances we get, no, all those balances will take to trial balance. Okay, so how we'll prepare this trial balance? We will prepare on a particular date, right? As at any given date, we'll prepare trial balance, right? So when we prepare trial balance, whatever the account say, we have discussed now, measuring account, cash account, Bharathi account, SBI account, Finance and Accounting Academy account. Okay, like this, all the account names will write here. And if the amount is expense, we'll write in the debit column. If the amount is revenue, we'll write in the credit column. Okay, like that we'll write all the amounts and finally these two amounts should tally. Means these two debit amount should be equal to credit amount. Okay, when we get both sides equal, then we can say that there is arithmetical accuracy in our ledger postings. What is ledger posting? From journal entries, if you are posting that to ledger account, it is called what? Posting. Okay, when this posting is done correctly, then this trial balance will definitely match. We'll prepare trading account, right? So what is trading account? When we are buying and selling, what we are doing? We are doing trading business. When we are doing trading business, to know whether we are making profits or not, means whether we are earning profit or not. When we are buying and selling goods, we can know only through trading account. Okay, in trading account, all the direct expenses we will record on the debit side, and whatever the revenues are there, see, sales is our revenue, so we are writing on the credit side. Okay, on the debit side, what we are writing? All the expenses. On the credit side, what we are writing? All the incomes. When incomes are more than expenses, then we'll get gross profit. Okay, say expenses are more and income is less, then here we will write gross loss. Okay, so this trading account will tell us whether our business is making gross profit or gross loss, right? Next, after trading account, what we'll prepare? We'll prepare profit and loss account. Profit and loss account, we will write all expenses and losses on the debit side. And on the credit side, what we'll write? Revenues and profits. Okay, so what P&L account shows? It shows incomes, profits, expenses, and losses. So what the gross profit we have gained in our trading account, that gross profit we will show in the P&L account on the credit side. First we will show gross profit. And if the business made loss, gross loss, then we'll write on the debit side. Top one is what? To gross loss brought down, right? So after preparing this profit and loss account, if the incomes are more than expenses, then we'll get net profit, right? If expenses and losses are more than revenue and profit, then we'll get net loss. Is it clear? Okay, so what we'll get under P&L account? We'll get all indirect expenses like administrative expenses, selling and distribution expenses, financial expenses, etc. Okay, on the credit side, what you will get? We'll get all rent received, commission received, interest received, gross profit, etc., etc. Right? You will come to know very clearly when we prepare final accounts. Is it clear? Now we'll go to next one. After profit and loss account, what we'll prepare? We'll prepare balance sheet. What is balance sheet? This balance sheet is prepared on a particular date. Say for example, 31st March 2025. On that particular day, what are our liabilities and what are our assets? In our previous video, that is basic accounting terms part 1, we have learnt about liabilities and assets. No, there I have explained you what is equity, what are liability. In the asset side also I have explained you what are fixed assets. Okay, and what are current assets. We have learnt about debtors, you have learnt about stock, right? So all those items we will show in our balance sheet. Okay, so our balance sheet will show what are our liabilities and what are our assets. So when we see balance sheet, we'll come to know what is our financial position. Okay, so in trading account and P&L account, what will come to know? We'll come to know about our profitability. Okay, in balance sheet, we'll come to know about our financial position. Is it clear? Yes. Next, we'll go to other terms called what is capital expenditure. What is capital expenditure? Say, for example, we are spending 5,000 rupees to buy furniture. Are you using furniture for only one day or for only 6 months or only for 1 year? No, we'll use this furniture for more than 1 year. We can use this furniture for longer period, right? Say, for example, if you are buying car, what is the purpose of buying car? We want to use for at least some years, more than definitely 1 year, right? So whenever we are purchasing any asset, and the purpose of purchasing that asset for longer period, then that expenditure is called what? Capital expenditure. Okay, for long term benefits, if you are purchasing anything, then it is called what? Capital expenditure. Here we can quote example of land and building expenditure. What is revenue expenditure? The expenditure for which the benefit is only for one accounting period. Means whatever the expenses we are incurring, say for example, we are incurring some expenditure for promoting our sales. Say for example, we are issuing samples, we are giving samples to our customers when they are purchasing, when they're coming to purchase our products. Okay, so these samples or advertisement cost, okay, or rent, whatever we are paying to our building, or office building, or factory building rent, or insurance, okay, audit fees, all these expenses whatever we are incurring for only 1 year, means the benefit of which will be for only 1 year, are called what? Revenue expenses. Okay, means revenue expenditure. Okay, why these expenses are met? Okay, these expenses are basically to maintain the business or to keep the assets in good condition. Okay, here I would like to quote one example. Okay, we all buy AC, right? Huh? We all buy mobile phone. Okay, I bought phone for 50,000. Okay, so what is that amount? That is called capital expenditure. And whatever the amount I am paying every month, whether it is prepaid or postpaid bill on my phone, is called what? Revenue expenditure. Okay, without recharging my phone, can I use? I can't use. Okay, why we require revenue expenditure? To keep the assets in good condition, means to keep my mobile phone working. I have to use what? I have to recharge my phone. So what is revenue expenditure? Recharging phone is my revenue expenditure and purchasing phone is my capital expenditure. In the same way, we all use coolers or AC, right? Or fans. Okay, when we are using, we have to pay electricity bill. Okay, so this electricity bill is called our revenue expenditure. Purchase of fan, AC, and cooler, what is that called? Capital expenditure. Is it clear to you? Yes. Next, capital receipts. What are capital receipts which are not occasionally received? Means which are not relating to day to day. Say for example, we are using one car and because of less mileage or something else, okay, not because maybe the car is not having good condition to drive for long rides. What you will do? We want to replace that, right? So when we want to replace, what we do? We sell our old car, right? So when we sell our old car, we get some amount. Okay, what is that called? That is called capital receipt. Or when we take loans, we'll receive some money. So what is that money called? Capital receipt. Is it clear? Next, revenue receipts. What are revenue receipts? When we receive money which is recurring in nature, right? Say we are having our own building. Okay, so what we have done, we gave this building for rental purpose to some school or some college. Okay, so that college or school will be paying us rent every month. Okay, so what is this rent called? This is our revenue receipt. In the same way, we are investing in banks as fixed deposits. Okay, banker will pay us interest. So that is also called what? Revenue receipt. Is it clear? So what is the difference between capital receipt and revenue receipt? When we occasionally receive, it is called capital receipt. When you regularly receive, it is called what? Revenue receipt, which is recurring in nature. Next, third expenditure is called, see, I've explained you capital expenditure, I've explained you revenue expenditure. Now I'm explaining you deferred revenue expenditure. Have you heard this word, deferred revenue expenditure? What is deferring? Means postponing to the future, right? Say, for example, in our business, we have incurred heavy expenditure. Okay, why we have incurred this expenditure? Maybe our business required heavy repairs. Okay, or we have made one advertisement which is very heavy advertisement because we want to attract more customers. Okay, so this expenditure of advertisement is also very high. Okay, next, third one, when we want to move our business to very convenient place. Sonata Software is having its business in Begumpet. Now they have shifted to Gachibowli. Why they want to shift? Because it is more convenient for them to have more working environment. Means there we can find more software companies, right? So when they want to shift from Begumpet to Gachibowli, they might have incurred more expenditure. Okay, so like this, whatever the heavy expenditures we incur, if we show all that expenditure in only 1 year, what will happen? In that particular year, there will be huge loss for that business. Right? So that is why what we'll do, we will spread that expenditure for 3 to 5 years. Say for example, we have incurred heavy advertisement cost rupees 30 lakhs. Okay, what we will do, we will distribute that 30 lakhs for 5 years. Okay, each year how much will show? 6 lakhs. So this is called what? Deferred revenue expenditure. Now we'll discuss about purchases, purchase returns, sales returns. What are purchases? When we are buying some goods for resale purpose. Say for example, I am having some garments business. So what I will do, I will buy garments from some factories and I will sell that to customers. Okay, so what I am purchasing? I am purchasing ready-made shirts or ready-made trousers and I am selling to different customers. Example, buying 10 shirts for 3,000 to sell to our customers. Okay, next, purchase returns. Okay, here I purchased some 10 shirts. What happened? After purchasing that, I have observed that out of these 10 shirts, 2 shirts are damaged. Means the stitching is not proper or something what happened. Okay, so what I want to do, I wanted to return to my supplier. Means what is happening? Whatever the purchase we have made, that we are returning to our supplier. So what is that called? Purchase returns. So generally, why you go for purchase returns, whatever you have purchased, why you want to return? Because of damages that got occurred to our products, what we bought for resale purpose. That is in terms of business. Okay, generally also we can understand what is purchase and purchase returns. We all buy through Amazon or Flipkart or whatever it is, right? So say for example, I have purchased one home decor item. Okay, when I have seen that in the Amazon website, that is very impressive. But after receiving that particular home decor, what I have observed that it is not of good quality. So now what I wanted to do, I wanted to uh, return that to the Amazon, right? So when I bought that home decor, it is called purchase. When I wanted to return that to Amazon again, it is called purchase return. Come to sales. What is sales? Selling of goods or services, right? When we see here, we can take example of one car showroom. Okay, so what they do in car showroom, they sell cars. But when these cars are to be taken for servicing point of view, what are the servicing businesses are doing? They are doing service, means they are doing that car servicing and they are charging some amount. In both the cases, they are selling, but car showroom is selling car and service companies are doing services. Next, sales return. What is sales return? When we are selling some goods, if the goods are not matching with the customer expectations, what the customers will do? They will return us that goods. Next, solvent. A person is said to be solvent when his assets are more than his liabilities, or when his assets are equal to his liabilities. Whatever the loans he is taking or whatever the amounts he is raising, all those amounts, if he is able to pay, he is called what? Solvent. Okay. Next, insolvent. Who is insolvent? A person is said to be insolvent when his liabilities exceeds his assets. Okay. Means whatever assets we are having, say 10 crores, but our liabilities are 15 crores. Okay, can we pay all the debts? We can't pay. So we are unable to pay our debts, then we are called insolvents. Okay, so what's the difference between solvent and insolvent? When we are able to pay all our liabilities very comfortably, we are solvents. When we are unable to pay our liabilities, we are insolvents. Okay, say here one example is given. Business declared bankrupt. Why a business is declared bankrupt? Because the business is not having capacity to pay its liabilities. Clear? Next, bad debts. Debts which are irrecoverable. What are debts? See, I have explained this topic when I have explained debtors in the first video of our basic accounting terms, right? So, what are debts? We sold our products to our customer on credit basis, right? So, our customer should pay our amount in future. But because of some reasons, he is not paying our amount now, which we can't recover also. Maybe he shifted to other country, or he may become insolvent, whatever the reasons. Example, 1,000 not received from our customer. We can't receive that amount. And in some cases, if the customers are buying with an intention to not to pay our amounts, in that case also we can't recover our debts. Next, depreciation. What is depreciation? This also I've explained you when I've explained asset in our previous video. What is depreciation? Reduction in asset value over time due to wear and tear or lapse of time. Say, for example, we are having one TV. Okay, the TV we can have perfect working only for 5 years. After 5 years, also, if you want to use the TV, then we won't get video or audio. We'll get all disco lights and dangerous sounds in from that, right? So, can we see the TV now? We can't see the TV. So that then what we'll do? We have to again purchase another TV, right? So that is why whenever we are purchasing TV, we have to depreciate that particular TV. Value of the TV is 50,000, right? The life of TV is 5 years. Okay. So 50,000 divided by 5 years. Okay. What is the amount? 10,000. So every year, the value of TV is decreasing by how much of amount? 10,000. Okay. After 5 years, we have to buy another TV, means 10,000 for all the 5 years is equal to 50,000. So we can buy another asset. That is why we have to provide depreciation. Okay. Here I gave an example. Machine loses its value 1,000 per year. Maybe the value of that particular machine is 10,000 and the life of the machine 10 years. So 10,000 by 10 years is equal to how much? 1,000 per year is the depreciation value of that particular machinery. Next, outstanding expenses. What are outstanding expenses? Say, for example, in a financial year, what is financial year? What is financial year? April 1st to March 31st. Okay, April 1st, 2024 to March 31st, 2025. Okay, March month salary, we have not paid in March month, but we paid in April month. So we are not taking in month of March in our financial accounts. Okay, so how you are writing? We are writing it as outstanding expenses. That means the salary what is unpaid is how much? 3,000. Means expenses which have become due but not paid at the end of the financial year. That is called what? Outstanding expenses. Here I gave example of unpaid salary. Unpaid salary, unpaid rent. All that will come under outstanding expenses. Next, unexpaid or prepaid expenses. What are unexpaid or prepaid expenses? Expenses which have been paid in advance. Say, for example, I am using mobile. Okay, I will do recharge. Okay, that is prepaid. Before using that phone, I am paying that expenses. Means, say, for example, I am using Vodafone. I am also using Airtel. So Airtel company and Vodafone company are taking amount before giving their services. That's called what? Prepaid expenses by the customer to the company. Paying our landlord every month in advance. Okay. So that means he is receiving our money in advance. So for example, this is June month. Okay. So June month rent I have paid in the month of May itself. So for me, what are prepaid expenses? My rent of rupees 5,000 is prepaid expenses for me, right? Next, outstanding income or accrued income. What is outstanding income or accrued income? Which is earned but not received. Okay. See, I gave some 20,000 loan. For that, I have to receive 2,000. Okay, I have to receive that 2,000 amount in the month of May. But I have not received that in the month of May. But I will receive in future. Actually, that interest is for which month? For May month. For May month interest, I have to receive, but which is not received. Is it clear? Interest to be received but not received means which income is outstanding, which is unpaid to me. Okay, is it clear? What is outstanding income? Means the income which I have to receive, still have not received because it is pending from the opposite party side. It's called what? Outstanding income. Next, income received in advance. Okay. Say, for example, we generally do functions in some function hall. So what we will do, we'll pay advance to them, right? So that function hall people are receiving our money in advance. So what is this called? Income received in advance or unearned income. Is it clear? Here I gave a detailed description about its features of accrued income and features of unearned income. Is it earned? In accrued income case, it is yes. In case of unearned income, it is no. Cash received, no, they have to receive. Here, yes, they have received. Okay, accounting treatment, it is called asset. Okay, and here unearned income is called what? It is called liability. Okay, example, interest earned but not received means our outstanding income means actually we have to receive interest now in this month, but we have not received. That is interest earned but not received. It is our asset. Okay, and liability here, advance rent received. This rent is relating to June month, but this June month amount I received in advance, that is in May month itself. So this is called my liability. Interest on capital. What is interest on capital? Say if you are investing capital in your business, so for that capital we receive interest. Means it's our reward, right? Because we made investment as owner, we receive some interest. This interest is called what? Reward. How much we have invested in our business? 50,000. So on 50,000, if the business is paying 10%, means how much you'll receive? 5,000. This interest on capital is expenditure to business, but income from our side, right? Interest on drawings. Why interest is charged on drawings? Though we are owner of business, though we have invested 50,000, we can't withdraw whenever we want, because when we have invested in our business, we are separate and business is separate. Say for example, I have started one business. In that business, I have invested 50,000 rupees. Okay, because it is my business, I can't withdraw whenever I want money. Say when I have started a business, Bharti is different and business is different. If I withdraw any money from my business, then I have to pay interest on that particular drawings amount. Okay, so that is why whenever we are withdrawing any amount from business, we have to pay interest. How much we have withdrawn? 10,000. Under 10,000, how much interest is charged? 5%. How much you have to pay? 500 rupees. This 500 rupees is income to the business and expenditure to us. Today we have discussed about what are expenses, losses, revenues, profits, what is journal, ledger, trial balance, trading account, profit and loss account, the balance sheet, capital expenditure, revenue expenditure, deferred expenditure, interest on capital, interest on drawings, depreciation. All these terms we have discussed in today's video. So this will be definitely helping you to understand future topics. My objective of doing this video as series only to make you to understand perfectly what is accounting. If you are watching this two videos very clearly, whatever the topics we are going to cover in future, all those future topics will be very easy for you to understand. That's all for today, but learning never stops. Please like, share, comment and subscribe. We'll meet in the next video. Thank you.